Most traders lose money not because they lack a strategy, but because they don't understand the basics. Pips, lot size, stop loss, entry points, and profit targets are the foundation of every successful trade. In this video, we'll break them down with clarity and precision so you can trade smarter, protect your capital, and grow consistently. Disclaimer: this video is for educational purposes only and does not constitute financial advice. Trading Forex involves risk and may not be suitable for all investors. Always consult a licensed financial advisor before making investment decisions. Having said that, let's begin. What is a pip? Definition and calculation. A pip stands for percentage in point and represents the smallest standardized price movement in a currency pair. Understanding this unit is fundamental because it's the metric used to measure your profits, losses, and the overall volatility of the market. For most major currency pairs, like the EUR or USD or GBP or USD, the pip is the fourth decimal place in the price quote. For example, if the price of EUR or USD moves from 1.154 to 1.1541, that constitutes a 1 pip movement. Similarly, a drop from 1.154 to 1.1532 is an 8 pip gain if you are short. However, for pairs involving the Japanese yen JPY, such as USD or JPY, the pip is the second decimal place. A move from 156.45 to 156.46 is a 1 pip gain. Mastering the concept of pips is the first step toward quantifying your trading performance and understanding price action with professional clarity. It allows you to set precise risk parameters and profit objectives, transforming abstract market fluctuations into tangible, measurable data points that inform every decision you make. Understanding lot sizes: standard, mini, micro. Lot size is the term used to define the volume or quantity of a currency you are buying or selling in a single transaction. It directly determines your level of market exposure and, consequently, the magnitude of your potential profit or loss. The standard unit is a standard lot, which equals 100,000 units of the base currency. How to calculate lot size based on risk. Calculating the appropriate lot size for each trade is a non-negotiable step for disciplined risk management. Instead of guessing, you should use a precise formula to align your position size with your predefined risk tolerance. The standard formula is lot size equals account balance risk percentage stop loss in pips pip value. Let's break this down with a practical example. Imagine you have a 1,000 trading account and you've committed to a strict rule of never risking more than 2% of your capital on a single trade. How to place a smart stop loss. A stop loss is an automated order placed with your broker to close a losing trade once it reaches a predetermined price level. It is, without exaggeration, your most crucial safety net in the volatile world of trading. Its primary function is to prevent catastrophic losses, ensuring that one adverse market move doesn't wipe out a significant portion or all of your trading capital. Trading without a stop loss is akin to navigating a minefield blindfolded. While you might get lucky a few times, a disaster is statistically inevitable. The placement of a stop loss should never be an emotional decision or based on arbitrary numbers. Instead, it must be rooted in sound technical analysis, reflecting the market's structure and volatility. Effective stop-loss placement is based on objective criteria such as chart patterns, support and resistance levels, or volatility indicators like the average true range ATR. Placing a smart stop-loss is an art informed by science. The most reliable method is to use technical levels that indicate a structural shift in the market. For a long buy position, place your stop loss just below a significant support level, a recent swing low, or a key moving average. The logic is that if the price breaks below this structural point, the original bullish premise for the trade is likely invalidated. For a short sell position, the opposite applies. Place the stop loss just above a clear resistance level or a recent swing high. Another advanced technique involves using the average true range ATR indicator, which measures market volatility. Entry points, timing your trades. Entry points are the specific price levels at which you initiate a trade. The quality of your entry point significantly impacts your trade's potential profitability and your initial risk. Professional traders rarely enter the market on a whim. They wait for confluence, a scenario where multiple independent technical signals align to confirm a high probability setup. For example, a powerful entry signal might occur when a bullish engulfing candlestick pattern forms directly on a major horizontal support zone, while the relative strength index RSI is simultaneously indicating an oversold condition. This alignment of three different factors, price action, market structure, and momentum, provides a much stronger validation for a long trade than any single indicator could alone. A core tenet of disciplined trading is to never chase the price. If you miss your planned entry, it is better to wait for the next opportunity than to enter late at a suboptimal price, which inherently increases your risk and reduces your potential reward. Utilize pending orders, such as limit orders, to automate your entries at these planned, optimal levels, removing emotion and ensuring precise execution. Profit targets. Setting realistic goals. Profit targets are predetermined price levels at which you plan to exit a winning trade to secure your gains. Just like a stop loss, a profit target should be set before you even enter the trade, based on objective analysis rather than greed or fear. Effective profit targets are typically placed at logical areas of technical significance where the price is likely to face opposition. These can include major resistance zones for long trades, support zones for short trades, significant Fibonacci retracement or extension levels, or previous swing highs and lows. A disciplined approach involves identifying these levels on your chart and setting a take-profit order accordingly. For more advanced trade management, consider using partial exits. This strategy involves closing a portion of your position, for example, 50% at your first profit target, to lock in gains and secure a risk-free trade by moving your stop loss to your entry price. You can then let the remainder of the position run, aiming for a secondary, more ambitious target, allowing you to profit from extended market moves without sacrificing initial security. Risk-to-reward ratio explained. The risk-to-reward ratio is a simple yet powerful metric that compares the potential loss of a trade, the distance from your entry to your stop loss, to its potential gain, the distance from your entry to your profit target. This ratio is fundamental to long-term profitability. A risk-to-reward ratio of 1 to 2 means you are risking $1 for the potential to make $2. A core rule for sustainable trading is to never enter a trade with a risk-to-reward ratio below 1 to 1. Ideally, you should consistently seek out setups that offer a ratio of 1 to 2 or higher. The mathematical advantage of this approach is profound. If you maintain a 1 to 2 risk-to-reward ratio, you only need to win 34% of your trades to be profitable, not accounting for commissions. This ensures that your winning trades are significantly larger than your losing trades, creating a positive expectancy over time. Even a trader who is right only 50% of the time can be highly profitable with a disciplined application of a favorable risk-to-reward ratio. Tools you need: calculators, platforms, indicators. To execute your trading plan with precision, you need the right set of tools. Your trading platform is your command center. Industry standard options like MetaTrader 4MT4 and MetaTrader 5MT5 are offered by most brokers, including reputable names like Exness, Markets, and XM. For charting and analysis, TradingView is an exceptionally powerful and user-friendly platform that allows for in-depth technical analysis before you place a trade. Beyond the platform, you must integrate specialized calculators into your trade routine. Use dedicated pip value calculators and lot size calculators to ensure your risk management is mathematically sound on every single trade. Within your charting software, indicators like the average true range ATR are indispensable for gauging volatility and setting appropriate stop-loss levels. These tools are not optional luxuries. They are essential instruments for a data-driven trader. Trading without them is like trying to perform surgery with blunt instruments. It's imprecise, risky, and unprofessional. Common mistakes and how to avoid them. Every trader, from novice to veteran, is susceptible to making mistakes. However, awareness is the first step toward avoidance. The most common and destructive mistake is overleveraging, which involves trading a position size that is too large for your account, leading to massive losses from small price movements. The second is trading without a stop loss, a cardinal sin that exposes your entire account to unlimited risk. Third is making emotional entries and exits, driven by fear of missing out, FOMO, or greed, rather than a sound analytical plan. Fourth is ignoring major economic news releases, which can inject extreme volatility into the market and dismantle even the most perfect technical setup. Finally, setting unrealistic profit targets based on hope rather than market structure can turn winning trades into losers. The key to overcoming these pitfalls is discipline and reflection. Keep a detailed trading journal to log every trade, including your rationale, the outcome, and the mistakes made. By systematically learning from each error, you can refine your process and achieve continuous improvement. Live trade example, EUR or USD setup. Let's apply all these concepts to a live trade example on the EUR or USD pair. Using TradingView, we analyze the 4-hour chart and identify a strong horizontal resistant level at 1.15307, which has been respected multiple times in the past. We observe a bearish hammer candlestick forming at this level, and the RSI is showing divergence, indicating weakening bullish momentum. This confluence of signals provides our entry trigger. We plan to enter a long position at 1.15307. To place our stop loss, we use 1.5x ATR, which is currently at 20 pips. We place our stop loss using ATR above our entry at 1.15615, giving us a total risk of 30 pips. For our profit target, we identify the next significant support level at 1.147. Final recap, you've learned how to calculate pips, choose appropriate lot sizes, place intelligent stop losses, time your entries with confluence, and set realistic profit targets. These are not just theoretical concepts, they are the practical building blocks of a professional trading career. Now it's time to act. Open a demo account and practice applying these principles without risking real capital. Use the calculators and tools we've discussed to build discipline and precision into your routine. Most importantly, stick to your plan and treat every trade as a business decision. Subscribe to our channel will guide you every step of the way.